Are you a beginner at options trading? When it comes to investing or trading in anything, we always have to balance risk and reward. More risk means potentially more reward, right? But what if there was a way to maximize risk and minimize loss at the same time? Well, there is, and that's called portfolio hedging. And I don't mean hedging the garden, but what I'm talking about is using options hedging strategies to your advantage. And in this video, I'm excited to share my strategies to maximize profits and limit losses on stocks you already own by using 5 common options hedging strategies for beginners. And don't worry, it doesn't matter what level you're at. If you're a beginner, a novice, or have been trading for years, you're sure to pick up something. Of course, if you're very familiar with options, you can go ahead and skip ahead to the first strategy. All right, so let's jump right on into it. People who buy options do so as a way to magnify potential returns because of the leverage that they get. But buying options without having a system is a little bit like going to the casino. You might get lucky on some far out of the money call option that you may have heard about online, but it's probably not a repeatable process. In fact, it's well known that almost every options buyer loses money. It's true. So if everyone's buying options and losing money, how do you make money? Well, this is a great question, and if you stick around, I'm going to explain you exactly that. Okay, so options come with a different set of jargon from stock trading. It's important to understand it all before hitting that buy or sell button on any options trade. Options are sold as contracts and are linked to underlying assets such as equities, like your favorite stock, forex, commodities, like chocolate, and so much more, like cryptocurrencies. Now, before we get into the types of options, we need to cover the 4 parts that makes up an option. First, we have the underlying asset, then we have the strike price, then we have the premium, and then we have the expiration. In this video, I'm covering equity options as they're tied to 100 shares of the underlying asset per contract. So that means 2 contracts on Apple means 200 shares of Apple. The underlying asset refers to the specific stock that's tied to the option. So a Tesla call, for instance, refers to a call option with Tesla as its underlying security. The option strike price is the price that the underlying asset will be either purchased or sold if the buyer exercises the option. For a call option, the underlying asset's market price must move above the strike price for the option to have any tangible value. On the other hand, put options have tangible value when the underlying asset price is lower than the strike price at expiration. When it comes to moneyness, we have in the money, at the money, and out of the money. In the money means the option buyer or holder will be profitable. They're holding a profitable option. And at the money or out of the money option will have little to no tangible value. Premiums are the amount that the buyer pays to the seller to buy the option contract. Premium prices are dictated by implied volatility, moneyness, and time to expiration. The expiration marks the end of the contract. Traditionally, options expired on the 3rd Friday of every month. However, today, many options expire daily, weekly, monthly, bi-weekly, and yearly. And some options, known as leaps options, expire years into the future. By the way, if you're interested to learn more about leaps options, check out this video up here. Okay, so once the expiration comes around, the holder can exercise their right, and depending on if it's a call or put option, they can either buy or sell the stock at the strike price if it's in the money. That means the stock trades higher than the strike price for call options or lower than the strike price for put options. Now, if the option expires out of the money, it has no value and expires worthless. And this is what almost every option seller wants. They want to collect their premium without being assigned. And I say almost because there are some situations where a trade is created with the intention of being exercised. But that's for a more advanced strategy, which I'll go ahead and cover in another video. When it comes to exercising options, it's important to know that there's two types of options for investors to trade: American options and European style options. And the difference between the two lies in when the option holder can exercise the options. With American options, the holder can exercise their right to purchase or sell underlying assets at the agreed upon strike price at any time before expiration. On the other hand, with European style options, the buyer can only assign on the expiration date. Naturally, whether you're holding American or European style options, exercising the option is only worthwhile if the option has tangible value, or as we say, it's in the money. Now, for the purposes of this video, I'm only covering American style options. A call option is a contract that gives the buyer the right but not the obligation to purchase an asset at a certain price within a certain period. The call option buyer pays a premium to secure this right. Someone who buys an option is said to be long, and long calls are bullish because the holder or the buyer profits if the underlying asset's price increases above the strike price. Now, the person who sells a call option, well, they're said to be short a call. They're taking a bearish position, and they could be forced to either sell the underlying asset at the strike price at any time should the option be profitable to the buyer. Now, a put option, this is a little bit more interesting. This contract gives the buyer the right but not the obligation to sell an asset at a specific price within a certain period. And like a call option, the buyer pays a premium for this right. Long puts are usually bearish because the owner profits if the underlying asset's price drops. So you could think of buying a put option kind of like buying an insurance policy on your stocks. It insures them against a price drop. The option becomes profitable if the stock drops in price. Before starting any investment strategy, you'll also want the right tools to help you profit as much as possible. And of course, we don't want you to lose any money. So for this video, I'm going to be using Option Samurai and Bar Chart, as these, well, they're two tools that I love to use every single day. And if you want to know more, check out the links in the description below. Not only will you get a free trial so that you can get a head start on your trades, but you'll also be helping the channel at the same time. Okay, so now that you've got the lingo down pat, it's time to cover the 5 options hedging strategies for beginners. They're basic strategies to limit your portfolio risk, but by no means is it an exhaustive list. They are, however, the most common strategies. Let's start with a protective put. This is probably the easiest strategy to understand, as it involves buying a put option, nothing else. The strategy is also known as a married put, and it's the most straightforward and easy to implement strategy. Protective puts involve buying put options on stocks you already own. So, if the stock price drops below the strike price, the gains from put options will offset those paper losses in the underlying stocks that you own. The best time to buy a protective put is when you're bullish in the long term, but you might want to protect the position from any sudden short-term losses. This is common, especially if you might need to sell the stock soon, or if you're trading on margin and at the risk of a margin call. For example, let's say you own 100 shares of Apple, and they currently trade for $178 a share. And let's say that you're concerned about recent news about Apple and you want to limit some potential losses. But at the same time, you're bullish on the stock. You think the stock is going to rise over the long term. So what do? Well, to hedge your position or to protect it, you could purchase a put option. You'd need to pick an expiration date, for example, 3 to 4 months or more. And the further out, generally the more expensive the premium is going to be. You'll also need to pick a strike price that you're comfortable with, say around 10% less than the current stock price, or 10% out of the money for this option would be the $160 strike price. In this example, to buy this put option, it'll cost you $3.35 in premium, or $335 per contract, and the expiration date is set for a little over 4 months from today. Fast forward 1 month, and the first scenario could be, let's say Apple stock price crashes to $100 before the option expires. Should you decide to sell your stock, this would amount to a loss of $78 from where the stock price was at the beginning. This is where a protective put helps. Since you hold a put option, you can exercise it and sell Apple stock for $160 a share times 100 times the number of contracts you have, even if the current price is $100 or any amount for that matter. And if you're wondering what a profit and loss would look like, well, it would look like this. However, if you didn't buy the put option in the first place, you would have incurred a loss of $78 a share. As a result, the put option hedged the position and limited the loss by 85.5%. But if by expiration, Apple trades above the strike price, well, the put option expires worthless. The premium is gone, and you get to keep the underlying asset while it continues to rise in price. Next up, we have the covered call strategy, and this is slightly different from the protective put in that it provides the investor an income stream that can supplement the portfolio gains and help reduce future potential losses. In fact, lots of traders love the strategy because of the income, and it's easy to understand. The covered call strategy involves selling call options against stocks that you already own. As long as the stock price remains below the strike price, you get to keep the premium from selling the call option. Now, if the stock price rises above the strike price, well, the option is going to be in the money, and any potential gains are going to be capped at the strike price. Essentially, the trader is foregoing some potential future upside of the stock in return for an upfront fee, the income. So again, let's say you own those same 100 shares of Apple and they're trading for $178 a share. You could look up Apple covered calls and find an option that expires in about a month from now. The first thing you'll want to do, though, is you're going to want to pay attention to the delta column. With a call option, the delta represents the chances that the option is going to be profitable. So if you're selling the call option, you're going to want to add 1 to the delta, and this will give you your chances that your option will expire worthless, which is what you want. So if the delta is, say, minus 0.4, the chances of your option expiring worthless is 60%. Now, when selling covered calls, if I want to keep my stocks, I prefer to find options with at least an 80% chance of expiring worthless. So in this case, I picked calls that expire in a little over a month and found that the $190 strike price has a minus 0.2 delta, or an 80% chance of expiring worthless. And I can collect a cool $1.34 in premium, or $134 per contract. So let's say the Apple stock bounces between $175 and $185 between the contract period. As long as it stays below the $190 strike price, the call option will stay out of the money and the buyer will not exercise the option. The call option seller, you get to keep the $1.34 in premium, and you can write another covered call against the stock. As long as the buyer does not exercise the option, the stock will not be assigned, and you can continue to sell a call option and receive those premium payments. However, if the asset price rises above the strike price, say Apple stock goes to $195, well, the buyer is going to exercise their option and you're going to be assigned, and that means you're going to sell your stock, your Apple stocks, for $190, limiting your potential profit that you could have had. But hey, you'll also have kept the premium. Now, you might be wondering, how do you find profitable covered calls? Well, there's another way to do this. Let's say you don't currently own the stock and you want to scan the market for opportunities to buy both the stock and sell a covered call. Well, websites like Option Samurai allow traders to scan the options market for contracts and allow you to filter or customize the scans by inserting parameters like implied volatility, options volume, expiration date, and so on. But the most important filter in this particular case is going to be the probability of expiring worthless, which you can set to any number between 0 and 100. Again, I like an 80% chance of a profitable trade, so I'm going to go and set that right here. You can put whatever number you prefer, but keep in mind, the higher the percentage, the lower the premium you're going to collect. The probability of expiring worthless is crucial, since the covered call strategy relies on receiving premium payments for assets that the trader, you, might want to keep for a long time. But there's some instances where you might be happy if the stock gets called away. And if that's the case, then I'd suggest selling in the money call options on stocks that you already own or that you're about to buy. Aside from that, the option scanner provides users with a step-by-step strategy, including entry prices for assets, strike prices, potential profits, and a lot more. Selecting any security appearing in the scans will show the suggested strategy at the bottom of the screen. In this case, we have a covered call on C Limited with a $44 strike price expiring October 13th that can net you 1.27% return over the period. And that works out to 14.37% annually. And the probability of expiring worthless is 81%. So if you don't already own this stock and intend to get into this trade, be sure to do so only if you want to own the stock. Now, option scanners aren't limited to covered calls. They offer scans for different option strategies of varying degrees of difficulty, which, well, traders they can choose from. And depending on their market tolerance, market outlook, knowledge, and so on, well, they can pick the right one that works for them. Next up, we have the collar strategy. The collar strategy combines the first two strategies that we talked about, a protective put and a married call. It's also known as a hedge wrapper to some people. To set it up, a trader sells a call option on a stock they already know, and then they use the premium from the option to purchase a put option. The combined position results in the trader limiting his or her upside while protecting them from the downside. The major benefit of a collar is its low or zero cost hedging strategy. Yes, you can hedge your portfolio for free using a collar. So let's say for a moment you own 100 shares of Microsoft and you want to protect yourself from a big downside risk at the expense of limiting some of the upside. In this case, we can see that Microsoft currently trades at $336. Well, in this case, you could sell a covered call with an expiration of a year out, meaning you're going to stay in the trade for a while. And take a look at this call option. It has a $385 strike, and with this you'd collect a premium of around $22.80. And the option is 14.5% out of the money, meaning that your upside is capped at 14.5% above today's price. Then you take the $22.80 you just collected and buy a put option on it. And on this case, you could buy the $320 put option. So what does this give you? Well, now you're protected from any potential losses below $320. That's only 4.78% away from the stock's current price today. And then you get to participate in all of the upside up to $385. And that's the hedge. Next up, we have straddles and strangles. Straddles and strangles involve buying call options and put options with the same expiration date and strike price for a straddle, or different strike prices for a strangle. They're used when significant price volatility is anticipated, as they can profit from substantial price swings. That's why if you're concerned about significant volatility, say going into earnings season, well, you can use a long straddle or strangle position to hedge your portfolio. Since the break-even point is high, price movements of the stock must be big enough to cover the premium. So here's how it works. Let's say you own Disney in your portfolio, and today it's trading at $81, and they're about to release their quarterly report. If you suspect the stock may experience a big price movement, in either direction, you can buy an at-the-money call option, in this case for $2.89, and a put option with the same strike price for 73 cents. That's for a total of $3.62, or $362 per contract. In short, your trade is profitable if the stock moves at least $3.62 over or under the current trading price, in either direction. So if the stock price moves to $90 at expiration, well, the call option will be in the money by about $9. And the option premium will be higher, likely almost around $9 as well. So you can either lock in the profit and sell the call option, or exercise it. To the call option holder, exercising the option means buying the stock at $81, the strike price, and then selling it back to the market for $90. And this will earn you $9 per share, less of course the $3.62 in premium that you paid, leaving $5.38 in net profit before taxes and fees. And of course, if the stock price drops to $70 at expiration, the put option will be in the money, and at that point, the trader can either sell the option for an $11 profit or exercise the put option. Now that was an example of a long straddle. Now a long strangle is very similar to the straddle. The only difference is that it uses two different strike prices for the call and the put option. Last but not least, we have the put ratio backspread hedging strategy. Admittedly, this is not the most common strategy, as it involves selling one or more put options and using the premium to buy even more put options at a lower strike price. It's used when the investor expects some significant downside movement, like a crash, and wants to protect their portfolio while potentially profiting from a sharp decline. So we're going to take a fictitious company. For example, we're going to call it Company XYZ that currently trades for $50 a share. If a trader is bearish on the stock and expects a soft price drop, but not completely ruling out a steep decline, they can write or sell one at-the-money put option at the $50 strike price for a $2 premium with a 1-month expiration. At the same time, they can purchase two out-of-the-money put options, let's say with a $47 strike price, and in this case they might pay a 75-cent premium for each. With this strategy, the trader pays $1.50 for the two put options they bought, but remember, they receive $2 for the written option, so this nets them a credit of 50 cents a share. Now, fast forward to expiration, and let's say that company XYZ, well, it's now trading for $43. Well, in this case, all the put options are going to be exercised. This means the option seller must buy the stock for $50 a share, resulting in a loss of $7 a share. Okay, wait. But since the investor also holds 2 put options at a $47 strike price, those are now in the money. And the investor can exercise those 2 put options that they bought, grossing a $4 per share profit. The P&L after adjusting for premiums looks like this. So you see, with this hedging strategy, the investor received a $1.50 profit per share instead of a $7 loss. So there we have it. Are these all the option strategies out there? No, but just the basic ones. I'd say before trading live, get a paper trading account. Try it first with fake money. And always know your chances of being profitable. You can use either an option scanner or a data source to help you out and give you exactly the information that you're looking for. As usual, if you have any questions, let me know, and I hope to see you in another video. Bye.